Thank you so much for joining us for our session today to talk about options, put options investing. So today I'll actually go through the basics of put option investing and why any serious investor should seriously consider using put options within their portfolio. So before I begin this presentation, I just want to share a basic disclaimer where actually whatever that we actually share here is actually just for education purpose and does not constitute as financial advice, and that past performance of investment typically do not represent future investment return. Now today this will be a very quick run through of some of the agenda. Today we will actually look at what exactly are put option. And we will take the perspective of both the put option buyer as well as the seller. And thereafter, we actually do a few case study. And lastly, I'll actually walk you through on how you can get started on trading options. So put option. So put option is actually a financial derivative, which actually provide the buyer the right to sell shares at a predetermined price at a specific date in the future. And typically a put option contract is for about 100 shares, right? Whereas on the other hand, put option seller basically means from the seller perspective, put option is a financial derivative that provides the seller the obligation to buy shares at a predetermined price at a specific date in the future. And similar to the buyer, this put option is also representative of 100 shares, right? So how does actually option works from the perspective of a put option buyer? So I just want you to imagine that you are a portfolio manager and you basically manage a portfolio of equities, and they basically the equity value will actually vary according to market condition. So as an investor, you basically face the risk of a volatile market, which may affect your investment portfolio value. And you're actually fearful that the market may decline in the near term. So you will actually like to use some put option or derivatives to hedge against your price decline. And this is effective because you now have the right to sell investment at a specific date in the future. So generally, put option buyer they generally have a bearish outlook on the market and believe that the market will actually fall lower. Now, I would actually like to share with you a payoff diagram that can basically explain how it works, how does it help you to hedge against a price decline, and how it helps you to preserve your portfolio value. Right, so just assume that this is what we call the merit put option strategy, right? So it looks very complicated. There are various things that are moving at the same time, but I'll actually just go through one by one. So the first dotted line is where the first dotted line here is where the share price, and the share price typically will move up and down, and your P&L will actually correspond accordingly. Next, what happens is if you have a put option, basically it actually stays flat. You actually have an incurred loss if it is within this range, and you start to make a profit as the price decline. So what happens if you own a share and you basically buy a put option to basically hedge against a price decline? Your payoff diagram will look something like this. And the reason is because if you buy a put option at a strike price of $200, assuming for Tesla, you will be able to sell Tesla shares at $200 no matter what happens, which means that beyond the $200 price point, typically your option has some value. And assuming that the option costs $2, your break-even price for Tesla will be $202. So above $202, you will actually make a profit. Now, what happens if it falls below $200, right? Because you now have the right to sell Tesla shares at $200, assume that it dropped to $180, you will still be able to sell Tesla at $200. So your loss is actually limited to basically just the option premium that you pay for that protection. And that is just minus $2. So I'd like to share with you how this works based on different scenario. So the first scenario is, just assume that Tesla shares is now $257 and Tesla share fell to $190. And assume that you actually hold Tesla shares. So when that happens, when Tesla shares fell from $257 to $190, you will suffer a loss of $67 due to the decline in the value of the share. But at the same time, your Tesla options, they also become in the money. So there is an intrinsic value of $67, right? So they offset each other. The downside in your share is basically offset by the upside in your options. And basically, so in terms of the option value, they will offset your decline in your share price. And the only thing that is having a loss right here is actually the cost of having this option, and that is $2. Now, the second scenario is also with what if Tesla share stays flat at $257? Now, in terms of share price, there's no change, so there's no gain and there's no loss. And in terms of the intrinsic value of the option, now it is $0 because basically you have, although you buy the right to sell Tesla shares at $200, you will not actually exercise it to sell because the market now is $257. You are much better off to just sell it at the current market price. And so your option has no intrinsic value. And once again, you have to factor in the price that you paid for the option, which is $2. So you would suffer a net loss of $2. And the last scenario is what exactly happens if Tesla shares rose to $300, right? So if Tesla share rose to $300, you actually make a gain of $43 in your shares. And this gain of this increase in value of your share is $43. But your option value will actually be $0 because basically, while you have the right to sell Tesla at $200, you will not do that since the current market price is $300. Very likely, it will be better for you to sell Tesla at $300. And given the fact that the option actually costs you $2, you will suffer a loss of $2 from the option, and this results in a net gain of $41. Now, let's look at a scenario where, let's say you actually short Tesla shares because you are super bearish on Tesla. You believe that Tesla shares will actually lose value. So assume that the current share price for Tesla is $257. And actually you buy a put option with a strike price of $200, right? Now, Tesla shares actually fell to $190. So there is an intrinsic value of $10 in the option because while the share price is $190, the option gives you the right to sell Tesla shares at $200, which means that there is a value of $10 for your option. And given that you actually paid $2 for the option, you will actually realize a profit of $8 from this transaction. And the second scenario is basically what happens if Tesla share fall moderately to $199. So what's going to happen here is that even though Tesla share fell to $199, you have the right to basically sell Tesla share back to the market at $200 due to the put option that you actually hold, right? And as a result, your option actually has an intrinsic value of $1. And given that you paid $2 for the option, you will just suffer a loss of $1. Now, Let's assume that actually Tesla shares lost the value, or sorry, Tesla shares stays flat at $200. What happens to your option price? Now, if Tesla share stays flat at $200, the option will very likely expire worthless, and the investor will lose the full $2 of option premium. And the reason is very simple, is because of the fact that you basically are indifferent between selling Tesla share in the market or exercising your option to sell Tesla share. And as a result, your option actually have no intrinsic value. And so you will lose that full option premium. And of course, the last scenario is if Tesla share actually rise above $200, the investor will lose the full option premium since there's no real value to the option. This is because you can definitely fetch a better price in the open market compared to compared to you exercising your option to sell your shares. So if you were following me right now so far, you will catch that put option buying is really using option as an insurance against price decline. So just think of put option buying as buying an insurance for your portfolio, and it helps you to basically hedge against any price decline that may happen to your shares. But when we talk about put option selling, it's a totally different concept, because put option selling is basically an opportunity for you to generate passive income based on stocks that you may actually want to purchase on a discount. Okay. And in the next few slides, I will actually share with you some examples of how you can do that and how it can actually benefit you. So using the same example, right? Let's assume that, right now you are a portfolio manager of an investment portfolio. But right now you basically see huge potential in Tesla shares, and you would like to actually purchase some Tesla shares, right? But maybe Tesla shares is too high. Right now it's $257, but maybe you would like to just buy it at $200. So there are few things that could happen. One is that you could wait for Tesla shares to fall to $200 before you actually buy it. But we are never sure that that may happen again. Tesla shares may never fall back to $200. It may keep rising. And so one of the things that you could do to reduce your risk when you buy Tesla shares is also using put options, because you can basically sell a put option on Tesla share at $200. And what is going to happen is that if Tesla share fell to $200 or below $200, you will have an opportunity to buy Tesla at $200. And while waiting for this opportunity to come up, you will actually earn the option premium or option income while waiting for this. So it is a way to generate income while waiting for shares to come down, so that you can basically buy the shares at a discount. So using this example, right, let's assume that this is Tesla share price, and Tesla share price has been recently very bullish, and you are an investor that would actually like to accumulate Tesla shares, but it is too high, right? So you could basically sell a put option, as we mentioned, at a $200 strike price with an expiry date of 14 July. And as part of the reward for selling this option, you will receive an option premium of $2, representing a 12 percentage point of yield. Now, the worst case scenario is, what if Tesla shares fell to $200 or below? What's going to happen is that you will have the opportunity to basically buy Tesla at $200, which also translates to a 23% discount from the current share price. So while at the same time, you will also earn the option premium. So this helps you in two ways. One, you basically get a better entry price of $200 instead of $257. The second way it benefits you is that, even if Tesla share never fell to $200 in the next few period, you are actually earning option income during this period. And having said that, obviously, if Tesla share rise above $200, it keep rising. you will get to keep the option premium, and you can continue to use your base capital to continue selling options to generate more income for yourself. So this is a very simple payoff diagram that I would like to share with you to basically sum up the things that we talked about just now. So assuming that you sell a put option on Tesla, we typically call it a short put. And let's say that the strike price is $200, which is the price that you are comfortable taking Tesla shares. Now, the current share price for Tesla is $257. So assume the first scenario, right, where Tesla share actually fell to $190. How would that impact you as an investor? So firstly, because you are writing a put option, you actually have the right to, you actually collected the option premium, right? So you will actually collect an option premium of $2. But because you, because you take the delivery of Tesla share, you actually come up with a capital of $200 per share. And given that the current market price of Tesla is $190, you will suffer a net loss of $8 per share. Okay, but if you are a long-term investor and believer in Tesla, this should not deter you, because even though you take delivery of Tesla shares, you are of the view that Tesla is worth more than $200, or it may actually rebound in the future. So you will actually hold to Tesla shares, and in fact, you will get a chance to hold Tesla shares at a discount from the current share price. So the second scenario is, what happens if Tesla shares stay flat at $257? What's going to happen is this: you're going to collect an option premium of $2. And because Tesla now is $257, it is much higher than the $200 that you $200 price point that you commit to buy. You will actually not have the opportunity to buy Tesla shares at $200. And so your option actually has lost its entire value. So if you were to repurchase the option, that would cost you just $0. So as an investor, you will actually gain $2 from doing this transaction. And while it does not sound a lot, this $2 actually represent a 12% per annum return, which is actually quite respectable if you consider the fact that, you know, now the S&P 500 is generally longer term, they give about 10 percentage point return. And also the fact that, you know, bonds are basically giving you 3 to 4% return. So basically you will be doing much better than these asset classes, while, you know, you are actually reducing your risk because you are committing yourself to buy a share below its current share price. Similarly, what's going to happen is that if Tesla basically rose beyond that, right? Let's say it rose to $300, you will actually get the option premium of $2, and your option will lose its full value. But you will actually basically get the opportunity to earn a $2 option premium, which is also translated to 12 percentage point of yield. So now I would actually like to share with you some case study for option trading and how you can actually take advantage of it for your own investment portfolio. So this is one of the example of a company that we basically have a very strong interest in. We also have done quite extensive analysis before we recommended this trade earlier this year. So this company is called Alphabet. For those of you who are not familiar with Alphabet, Alphabet is actually the parent company for Google. They are also the parent company for YouTube and Android operating system. So basically, if you were to use any Android phone, you were to use your Google search, this is the company that actually is behind it. And you know, from our analysis, we know that Alphabet is a market leader. They hold about 80% of the market share, 80 to 90% for search. And basically for Android software, they are basically looking at almost at least 50 percentage point of market share. So this is a very solid company. And And what happened back then was that basically Alphabet shares have shown us that there is a great opportunity from a technical analysis point of view because of a golden cross formation where the shorter term moving average actually cross above the longer term moving average. And when this happens, it usually means that in the short term there is very strong bullish momentum for the company, where shares are actually expected to move higher. So we believe back then that as an option seller, if you actually have a great advantage if you were to sell option on Alphabet, for two very simple reasons. Firstly is the fact that Alphabet is a very strong company, so you are actually committing yourself to buy Alphabet shares, which is a very great company, at a price below the market price if eventually you get assigned the shares, right? And secondly is the fact that because shares are expected to move up, the chance of you taking delivery of the share is actually not very high. So that is why we believe that you can actually earn a respectable yield if you were to sell option on Alphabet shares. And basically based on the option price at that point in time, the $104 strike price option was basically priced at $1.97 for 1 month. So basically, if you were to sell this 1 month option, you could get a yield of 1.9%. Once again, while it may not sound like a huge dollar amount to you, 1.9% over a 12-month period is almost 24 percentage point. And it is not easy to basically beat a 24 percentage point return. So that is one reason why we believe that selling put option can actually help you generate good, consistent, regular income if you pick the right underlying and you do the right analysis. So this is one example of how you can basically generate good regular income on high quality companies. And you reduce your risk because basically you are committing yourself to buy a high quality company at a discount. Now, this is a second example where we actually saw how you can actually make use of put option to basically profit. But this case is a company that, with Blackstone is an asset management company. It has done very well since 2019 all the way to 2022. Because at that point in time, we have a very low interest rate environment, and Blackstone as an asset manager, they basically take advantage of the low interest rate environment to do private equity deals and as well as real estate deals. But what happened after 2022 was the interest rate started to increase, and basically that affected the profit margin of their deals and their real estate property. And that's also why you see a decline, a downward trend channel since 2022, which typically indicate bearish momentum. So back then, when we recommended this trade, we were of the opinion that the downtrend will continue, and we believe that Blackstone will not hit above $88. So our recommendation back then was we suggested investors to buy a put option of Blackstone at $85 when Blackstone was trading at $86. And back then, the option premium will cost you $3.55. Now, our recommendation back then to investors was to basically take profit from this put option buying the moment Blackstone shares fell to $74. So this actually represents a potential profit of $11 because you have the right to sell Blackstone shares at 85, but Blackstone shares is $74 right now. So your option has an intrinsic value of $11. And your potential loss is really limited to just the option premium, which is $3.55. So this trade setup itself actually represented a reward to risk ratio of 3-1. And that's why we believe back then that this is an attractive opportunity for investors who are bearish against Blackstone shares. you can actually make use of put option to bet against Blackstone shares. So this is one way for you to basically short the market without having to worry about, your margin facilities, your margin call and things like that. And basically you have an opportunity for very big upside while you limit your potential loss to just your option premium. So having said that, the question is, how can I get started on option trading on our app? So with that, I'd actually like to share with you our app, our interface, and how you can take advantage of it. Okay, so basically you can click on our app. This will show you the list of stocks. You can click on any of the stock that you are interested in. So for example, we are interested in Alphabet, right? So they will actually lead you to this landing page here. You can actually click on on the top of the banner, you can see that there's the Alphabet, the ticker, the share price, and there is the option tab beside your code. Okay, so you can click on the option. So right here, they'll show you different things. They'll show you the strike price, the different strike price, and they'll show you that there's call option and put option. So basically, you can select the one that you want based on your view on the market direction. So if you are bullish, you think the market is going to go up, you can go ahead for the call option. If you're bearish, you can go for the put option. Okay. And you can basically also select the different time horizon. So by moving the little bar above, you can basically select, okay, which day do I want? Yep. So now we have selected the 21-day one, which is 30th June. And then you can basically select the particular strike price you want. You can click on it, go in. So right here, you can actually look at the bid and ask price for this option for you to basically gain greater clarity. So this is basically a call option where we have the bid and ask price. Over here, you can click on trade to place an order. There's a buy and a sell tab. So the buy tab is basically allowing you to buy the option. And so if you want to buy the option, you have to click on the buy side of things. And then right here, you can look at the bid and ask price as well to help you gain clarity on what is the prevailing market price. And at the order type, there are different type of order. There's limit order and market order and various type of order that uSMART support. So limit order is basically putting a price that you like to trade it on. So right now we place a limit order at 241, which means that the order will get filled if the option actually trade at $2.41. But of course, if the option actually move outside of this range, this price may not get filled. Okay, so now let's move on to the selling side. This is for people who want to generate some source of income. So when you click on sell, there's also the bid and ask price at the same time. So feel free to basically put in a price where you believe that this order will get closed. If you are happy with everything, you can click on the sell button and confirm. This is where you will actually successfully sell the option premium. And if you are comfortable, you really like the market price, which is what the bid price is usually quoting for a sell order, you can go ahead and place a market order. And with that, I've largely covered the content with regards to put option investing. And if there's any questions, please feel free to post them in the Q&A. I'll try my best to answer as many questions as I can. Okay, so the first question that I've received is, okay, how do you decide which companies do you sell put options on? Okay, so when it comes to put option selling, I think what really matters is that the underlying stock has to be good. So so my suggestion is usually try to go for blue chip companies that have a market leading position. So for example, like if you are interested in the tech sector, there will be companies like Microsoft, who is a leader in cloud computing, enterprise software, or Amazon, which is a leader in e-commerce, or even Google, which is a leader in cloud computing. Cloud computing search as well as Android services. So go for companies that are market leader in their respective field. Basically pick something that you are comfortable with, something that you have some experience with, and try to pick companies that have growing revenue, companies with good profit margin. So these are some of the recommendations that I would basically suggest if you were to do a put option selling. Okay, the second question that I see coming in is, is McDonald's shares a good share to sell put option on? Okay, there seems to be a lot of interest in put option selling today. So maybe it's because the fact that you can generate passive income from it, or rather generate regular income from it. So I think McDonald's is one example of a company that I think is a good company to sell option premium on. And let me explain to you why. Okay, because firstly, if you look at McDonald's is a market leader within the space that it competes in. The fast food chain, McDonald's has one of the best brand among the fast food industry. Secondly, McDonald's business model is actually, interestingly, they make money from real estate. So McDonald's will actually first lease out land at a particular restaurant, and they will sublease it to the franchisee. So they actually earn rental income from their franchisee on top of the franchise fees, on top of the fact that your franchisee have to buy their inventory from McDonald's. So it creates this very sticky relationship with their customers, and that is why McDonald's business model is extremely strong. And because McDonald's they have built such a strong brand, they basically have regular customer coming in. So their demand for McDonald's is very stable. Their revenue, their profit margins are very stable. And so this is a company where the shares will not fluctuate a lot. It is not very volatile. So if you were to sell put option on it, even if you were to get assigned McDonald's shares, basically you actually bought McDonald's shares because of the put option. You don't have to worry, because basically McDonald's shares is likely to bounce back up, or even just stay flat near around the price that you paid. And you can actually continue to generate income by selling a covered call for your McDonald's shares to be called away. So I would say that don't worry too much. This is one of those counters where I have very strong faith in, and I think that you don't have, and I think that because it is not a very volatile stock, it is actually a good candidate for selling options. Okay, the next question is also on, will it be a bad idea to buy put options in the current market landscape? So I think the current market landscape is an environment where basically there's a lot of uncertainty regarding what interest rate is going to be like. So interest rate will be the major driver behind the stock market performance in the next few months. And the general consensus right now is that interest rate would stay flat for the current cycle, but basically there may be one rate cut by end of the year. So if that happens, then we could be looking at a stock market rally and rebound in the second half of the year, right? But having said that, if inflation data continues to remain strong, there's always a possibility that the Federal Reserve will reverse that decision and go from cutting rates to raising rates. So that will actually depress the stock market in general. And so if an investor will want to actually hedge against this risk, buying put option is one of the possibility, because if the stock market actually crash, your put option will actually increase in value and basically offset the market decline. Okay, I think that is all the questions that we have for tonight. Very big thank you to everyone that has taken their time this evening to basically join us for this series. In the coming series, my plan is really to come up with uh, webinars that actually share more complex option trading strategies where and how you can actually take advantage of the different market environment. So the next few sessions will be more practical. I'll try to use more real life examples to tell you what are good companies, how do you pick the underlying, how do you basically find the right strategies for different environment. For example, bullish, bearish, or when the market is moving sideways. Okay. And I hope that you have a great week ahead. Thank you so much for joining me on this Friday evening. Okay. And we shall see you soon.